Welcome back, traders. We're going to introduce you to another indicator. This one is called the RSI, which stands for Relative Strength Index. As with all other indexes, it basically gives you an output between 0 and 100. But I tell you what, let's go and add it and we'll look at it while we're doing it. So we head on over to our indicators list button again, and you will find it under Custom and then RSI. See here we have the About section again. We click on over to Common. We don't need to change any of these settings. Then under Inputs, we have the RSI period. With all indicators, remember that the period is how much historical data is it going to take into account to give us the actual value. RSI responds very much like other indicators where you have to weigh up the pro and the con. If you have a smaller period of say less than 10, then you find that the RSI responds too quickly and is just totally unreliable. However, if it does work, it lets you get in very early. If you set a larger period, then the RSI will take too long to respond. So it is more reliable, but sometimes it takes too long to respond and the trade has already happened, so you don't get to trade as much. We're going to leave it on 14. This is the default for MetaTrader, and I think they selected 14 because it seems to be the most common and most popular used value. Under colors, we can leave it as Dodger Blue, that's fine. And levels. This is where I add a third level just to make life a little bit easier. You can click on the Add button on the right hand side, and you will get this box over here, and we're going to add the level of 50. Next thing I'm going to do, so you can actually see my chart, is change the color to black. And once that's all done, I'm going to click OK. You'll see that the RSI has formed as an oscillator at the bottom. It's not sitting on the chart itself, and it looks kind of interesting. It looks a little bit like a moving average. What the RSI is doing is it's looking at the history determined by what period we set, and in this case we have it as 14. And it is measuring the average direction of the most recent candles. It is then looking at, is the market mostly bullish or bearish? And that's what it's trying to tell us. It's trying to confirm the bigger picture or the larger trend. If the RSI goes above this 50 line, like in this example here, it's telling us that the market is in a bullish movement. This means that we are expecting the market to continue heading up. If it is below the 50 line, you find that the market is in a bearish movement, meaning that it is going down. So if we look at current time right here, we see that the RSI crossed the 50 line, and from this point, we're expecting bullish movements. The other thing to take note of is it's important to look at how far away from 50 it is. If the market is on 50 or very, very close to it, then either the market is changing direction or it is saying that there is no clear direction. Either way, we don't really want to trade unless we have some kind of confirmation on that. Once it is comfortably above 50, like let's say it's sitting at 55 or higher, then we know that the market is looking good for buys. When it is comfortably below 50, say 45 or lower, then it's looking comfortable for sell positions. The reason why I leave the 70 and 30 line in is that it doubles up as a way to tell if the market has moved too far in a particular direction. If it goes above 70, that is extraordinarily strong for a bullish movement, and it is highly unlikely that it will continue like that. So if we're looking at a buy, say we're using a trigger and a confirmation that's telling us, right, it's time to buy, but the RSI is above 70, it's telling us, no, this is way, way out of the norm, this is very unlikely. And we can see here with the short position, we had a situation where the RSI was very positive and it shot down below into a bearish movement, and it went below 30, very much below 30. So this would be an extremely dangerous time for us to be trading short positions as soon as it goes below that 30 line. If I go back into history, we should see a few more examples. Look over here. The market has gone above 70, and this is mostly because of this weekend gap here, which makes it unreliable. But it has gone above 70, so it's telling us this is not a good time to buy. And luckily that we have this, because we can see that this might have looked like a decent buy opportunity if we're using crossovers and that sort of thing, but RSI is warning us against it. And we have the same thing here with the sell position. the RSI went below 30. So anytime from here, the RSI is telling us it is too dangerous to enter a sell position. I personally find that RSI is not very good to use as a trigger, which is why I'm not introducing any trigger systems for the RSI, but it does make a very good confirmation. You might want to play around with changing the period to see how it's working, but we'll cover this sort of thing in more detail in backtesting. For now, just remember the RSI is showing you the bigger picture. It's helping you determine the direction of the market. It is also telling you when it's very dangerous to trade, similar to the stochastic. Think of it as an overbought or oversold position, that the market has moved too quickly in either direction and therefore it's too late and too dangerous to enter the trade.